Let's check in with a professional. David Kudla, founder, Chief Executive Officer, and Chief Investment Strategist. He kind of does everything there at Mainstay Capital. He joins us from Troy, Michigan via Zoom. David, what do you make of a week ago Friday, what we saw, particularly in the morning, to what we've seen since then? What are these markets telling us?
Right. Yeah. So we had that growth scare because of an ISM, a poor ISM and non-farm payrolls number 2 weeks ago. And that was aggravated by the yen carry trade issue. With a week ago, with jobless claims, we got a little bit of help there. And of course, the data today with retail sales, jobless claims a little better than expected. But I think look at the data yesterday, or let's say Tuesday through today. Tuesday, we had PPI coming in well below expectations. Yesterday, we had CPI coming in slightly below expectations. Headline inflation is below 3% for the first time in a long while. And now today, we have retail sales, kind of a blowout number when we're expecting 0.4 and get 1%, which says the consumer is still strong. If I'm going to loosely borrow a Mark Twain quote, reports of the consumer's demise have been greatly exaggerated. Mm-hmm. We need the consumer to stay strong. It's 2/3 of our economy. They were certainly strong last month. So look what we have. We have growth with lowering inflation. I don't want to overstate it, that it's a Goldilocks economy, because we do have a real fear of recession. We need the Fed to get started on their easing cycle. And I think it'll be 25 basis points and not 50 in September that many are predicting. Mm-hmm. But they need to get going. And they have the room to do it. We're on a good glide path on inflation. And when we have growth with inflation slowing, that's a pretty good scenario for the economy.
Why are rates up then right now in that scenario you just lined up?
Yeah, well, rates are up today because the retail sales number came in so strong, right? More than double expectations. And, the growth scare of 2 weeks ago, it's really been a significant change. The comparison that Paul was talking about from 2 weeks ago to today. So, Alex, we've really seen, a terrific number that tells us the consumer is still out there buying. And that's all important, right? For the U.S. economy, the consumer is all important. It's 2/3 of consumers, 2/3 of our economy, and that was a very reassuring data point. But it means the economy is a little bit stronger than we thought. Bond yields go up 5 or 7 or 9 basis points.
So what type of stocks, what type of sectors work in an environment, David, where the economy is hanging in there, maybe slowing, but hanging in there? But we now have the prospect for lower rates. What kind of sectors screen well for you guys?
Yeah, so first of all, we like the secular growth stories like mega cap tech for a long time, and we still believe in the AI plays. But now we can look at cyclical plays. Take financials, that have struggled so much over the past years. Now we actually had the yield curve uninvert briefly last week. And we're certainly seeing a steepening of the curve. And as the Fed starts to cut rates, we'll see that steepening of the curve, which will be good for financials because NIM, net interest margin, improves. So we like financials. Mm-hmm. We've been extending bond duration. We had for over a year and probably 15 months had been in ultra short-term bonds because we just wanted to capture the yield and we didn't want the interest rate risk. And that was a good play. But now it's time to be extending duration because we know the Fed is going to be cutting. Forecasts are still about 100 basis points by the end of the year. That's, with that easing in place, that means we want to lock in rates and extend our duration. Mm-hmm. And we also are broadening. It gives us an opportunity to broaden portfolios into small caps, values, cyclicals, mid caps, areas that we had been mostly buoyed in favor of large cap and large cap mega tech.
But what about the idea that with small caps, the PE ratio, so the P part wound up re-rating enough that, okay, maybe you want to buy it, but maybe that thesis is out the door a bit because small caps did have a run before the growth scare, but that the E part isn't really holding up. That's what I hear a lot about the small caps naysayers.
Yeah, 42% of the small cap stocks in the Russell 2000 aren't profitable. It's a struggle. If a small cap stock does well, it grows into the mid cap region and it leaves the Russell 2000. So here's what needs to happen for small caps is we really need what's coming, the rate cuts that are coming, avoid a recession, and the PE multiple of small caps is so attractive compared to large caps at this point. We were hitting earlier in the year historical highs, multi-year delta of PE of large caps versus small caps. So the attractiveness is there, but we need the right kind of environment. Data like today, we've seen what the Russell 2000 did today in early trading, up over 2%. And if we get the rate cuts, the economy can be slowing a bit, but no recession. That's a good environment for small caps, for value, for cyclicals.
Do you think the Fed is going to go 25 or 50 basis points, and do you even care?
First of all, that's a good way. That's a good way to ask that question. Do we even care? The most important thing is they get started. The first cut means they switched from a neutral stance to an easing bias, right? From neutral to easing. So the first cut is symbolic in that regard. I think that they will go 25 basis points, because if they go 50, and I know what the case is for that, for the case that others are making, but then it raises a question: Are they doing 50 because they're behind? I mean, they've still got November, December. They've still got more meetings to achieve 7,500 basis points by the end of the year. Maybe even do a half cut later. I just wouldn't start there again for symbolic reasons. So I think they do 25. But the part about do we even care? The main point is they get started. Let's get going, Fed. Let's get the first cut in there and establish you have changed your bias to an easing cycle.
But to that point, something that I feel like is becoming more of the conversation, I think it was Bostic that mentioned this when he was speaking to the FT, is that you had a delayed reaction and transmission mechanism of policy on the way up with rates, so why not expect that then on the way down, which implies that we do need to see sort of a little faster, more aggressive cut so it filters through the economy a little faster. What do you think about that part?
I think that's actually, it's absolutely right. I mean, when we talk about Fed policy and the mistakes they made the mistake of 2021 of staying easy for too long. Continuing to buy mortgage-backed securities, making mortgages so attractive. People saw their house price go up 1.5 times or double in a couple of years, and they helped create the problem of inflation with the first policy here by staying easy for too long. And they probably are going, when we look back, they probably will have stayed tight for too long. 5.25 is a restrictive policy. Inflation is on a glide path to their target. It's time to get on with cutting rates. Probably should have cut 25 in hindsight. They probably should have cut 25 in July, and then they'd be ready for another 25 in September. And that's what might beg the question. They need to do 50 to get caught up. But yeah, our concern is they make the same mistake on easing as they did on easing now as they did on. They were easy for too long, went way up to drove it up to a restrictive policy, and now they got to get on with it.
All right, David, thank you so much for joining us. Always appreciate getting your views. David Kudla, he's a founder of Mainstay Capital Management, joining us from Troy, Michigan via Zoom.